Welcome back to. Thank you for joining us. If you follow finance and are concerned about recent shifts in the bond market, this video is for you. Serious. The $30 trillion U.S. Treasury market is showing signs of stress. Right now, the cracks in global markets are coming from bonds, not stocks. Yields are rising, volatility is increasing, and liquidity is drying up. Unlike past crises triggered by banking collapses, housing bubbles, or tech frenzies, this time the driver is war. On Thursday, U.S. Treasuries sold off, with the two-year yield rising to 4%, up 0.62 points this month, the worst performance since September 2022. An auction earlier this week also performed poorly, reflecting waning investor confidence. Size, traders rushed to unwind U.S. futures positions, a move Morgan Stanley describes as placing the market near an inflection point. Concerned, policy reversals and unpredictable decisions have shaken global trust in U.S. financial stability. Investors are retreating from treasuries, pushing yields higher, while domestic economic conditions are deteriorating. Government workers went unpaid for weeks even as billions were spent on military actions abroad. Since U.S. and Israeli operations in Iran began, treasury markets have shifted dramatically. The 10-year yield has surged, showing that investors now demand higher returns due to increased risk. Treasuries are no longer a guaranteed safe haven, reflecting worries about inflation, rising deficits, and economic uncertainty. Treasury market volatility has spiked, reaching levels historically linked to instability. Rising yields combined with increased volatility are rare and dangerous, signaling weakened confidence in the world's safest asset. Geopolitical shocks, especially conflicts in the Middle East, are adding to energy market uncertainty. Rising oil prices increase inflation risk, affecting monetary policy decisions. The Federal Reserve faces a difficult scenario. Rate cuts once expected may be delayed or replaced by even higher rates. Investor expectations have shifted sharply, from anticipating cuts to now preparing for extended tight policy. Liquidity is also deteriorating. Market depth, how easily assets can be bought or sold, is declining as fewer participants are willing to trade amid rising risk and uncertainty. In some areas, liquidity has dropped 40 to 50%, with sharper declines in derivatives markets. Reduced liquidity fuels volatility. Recently, major Wall Street banks even disabled automated trading systems, forcing manual pricing. In the world's most critical financial market, participants struggled to price assets, signaling stress and uncertainty. The Treasury market underpins nearly every global asset class, from mortgages and corporate debt to equities and currencies. When this foundation becomes unstable, risks ripple throughout the financial system. Rising yields increase borrowing costs for businesses and consumers, tighten financial conditions, slow growth, reduce jobs, and increase unemployment. Persistent inflation risks make monetary easing unlikely, removing key market support. Vulnerable sectors, like private credit, are already showing strain. If stress spreads, these areas could fracture first, triggering wider contagion. The bond market is sending a clear, urgent message. Investors are reassessing risk, demanding higher compensation, and reacting to increasing uncertainty. This is not just a story about bonds. It's a warning about the stability of the entire financial system. When the foundation cracks, everything built on top becomes fragile. The question is no longer if markets will react, but when and how severe the impact will be. What are your observations about the current economic environment? Share your insights in the comments below. Thank you for watching Terra Alert News. Your support through likes, subscriptions, shares, and paid memberships helps this channel grow. Stay informed, and we'll see you in the next update.